So before we start messing around with how do we translate a foreign operation into the US company, let's first of all focus on a singular US company with no foreign operations but is engaging in transactions with other entities, other companies, other organizations, where we are actually taking some risk exposure in that foreign currency. So maybe I have a deposit in euros, in cash, sitting in Paris. So I do some business in Paris and I want to make sure that I have a bank account in Paris and that bank account is in euros. Or I'm doing sales to a Canadian company or to a Mexican company or to a to an organization in China or wherever, and I'm doing sales, but the sales are not in U.S. dollars. We are taking back yen, or we are taking back pesos, or we are buying, and we're buying using pesos. If all of these transactions were consummated in U.S. dollars, then we don't have foreign currency risk. So what we've got to be thinking about is, am I transacting business in any kind of a currency other than the US dollar, which is our functional currency, right? So if we are dealing with things that are not our functional currency, we've got to do something. And so we go over to our literature, over to 830. We'll take a look at overall. Actually, we'll take a look at foreign currency transactions because that's what we're dealing with. And when I take a look at recognition, which is paragraph 25, the literature is very clear. At the date of a foreign currency transaction is recognized, each asset, liability, revenue, expense, gain, or loss arising from the transaction shall be recorded in the functional currency of the recording entity. We're dealing mostly with U.S. companies, but imagine if you had a foreign company where their functional currency was the euro and they're doing things in US dollars. Well, then they would have to, if they are trying to comply with US GAAP, they would have to convert and record that transaction to their functional currency. So any type of transaction that is defined as a foreign currency transaction, which is not our functional currency, we've got to translate that to the functional currency. We'll talk a little bit later about, well, what do you do when you have to make that change? But before we get into looking at individual transactions, I want to make sure we understand what is something that we're going to have to spend, what are going to be some of the potential transactions, assets, liabilities, revenue, expense, what is it that we are going to ultimately have to figure out that we have a foreign currency transaction that needs to be changed. We need to do something with that. So when we think about a transaction, any kind of a transaction, okay, buy, sell, whatever, there are three dates that we've got to focus our attention on. The first date is the transaction date. That clearly is the date we are engaging in the business. Transaction date also coincides with the day that I may be permanently obligated. I can recognize revenue. I've incurred an expense. I've taken possession of an asset. I now have a liability. Those are going to be the transaction dates, right? There is some obligation on my part, or I have been able to, there's some obligation on somebody else's part. on that particular date, right? So the transaction date, I may sign a sales order, right? But no one's obligated to pay me when I do that sales order, generally. There may be situations where if you back out of a sales order, you still got to pay me something. But let's take it as a simple case where on the transaction date, we have an obligation or someone has an obligation to us. Right? The other date that is important is the settlement date. The settlement date. The settlement date is the date where cash changes hands. So if we think about some of our transactions that we have executed, some of the contracts we've executed, so we think about revenue recognition, and we'll talk a little bit more about revenue recognition in a little bit. Think about revenue recognition. Well, the transaction date is when I get to record it on my balance sheet. So you got to always think about, well, what's the revenue recognition standard, right? We have to go back and think about what are the 5 criterion to be able to recognize revenue. But settlement date and transaction date may not be the same. So if I do a sale and I collect the cash on that day, then the settlement date and the transaction date are the same. And if I am settling in the foreign currency, then as we move forward, there is no foreign currency risk because I'm settling it in that foreign currency. Unless, of course, I keep it in the foreign currency sitting in a bank. Make sure we understand that. That is, we have to be clear on this. For these transactions, if the transaction date and the settlement date are the same, you don't have a foreign currency translation unless you keep the cash that you collected in the foreign currency in your bank. Now, for the most part, there is going to be some space between transaction date and settlement date. And, if it's a week apart, 2 weeks apart, it's not going to have any effect on what I'm doing. Because I will, if I agreed to a certain amount of money in yen on this day, right, whatever the US dollar equivalent is, that's what I think I'm going to get. If the exchange rate changed between the transaction date and the settlement date, then I'm either going to get the same amount, I'm going to get the same amount of yen, but it may not be worth as many US dollars, or maybe worth more US dollars. But if the transaction date and the settlement date are pretty close together, and they don't jump over the third date, then I really don't have much to do other than execute the transaction and collect the cash. In this particular case, it would be a foreign currency amount, and then turn that into US dollars, or I keep it in the foreign currency sitting in my foreign bank account. The third date, which is the reason why this comes up, is a balance sheet date. That could be annual or quarterly. If your balance sheet date is between your transaction date and your settlement date, on the balance sheet date, you have to revalue all of these transactions to whatever is the current exchange rate. Have to do it. So we when we took a look at that particular part of the literature, it said it has to be recorded at the functional currency. So we're gonna at transaction date, we're gonna record at the functional currency, and then settlement date will also settle at the functional currency. But between these two dates, we got a balance sheet date, we may have to revalue the outstanding assets, liabilities, revenues, expenses, gains, losses, etc. So everything here has to be recorded in the functional currency. At the transaction date, at the balance sheet date, and at the settlement date. And if there's any change in our exchange rates, between this date versus the balance sheet date versus the settlement date, we have to always be recording at what is the economic reality given how much yen I'm going to get, how many pesos, how many euros that I'm going to receive.